There is one component that is a distinction factor between a professional trader and just a normal trader or a newbie in the market, right? So the professional trader prepares for the market, while an ordinary trader just wakes up on Monday and they just go into the market and whatever they find, they trade, right? So that's one thing that differentiates one from the other. And in this video, I'm going to show you how to prepare and how to actually trade like a professional and how to execute and everything else. All right. So make sure you watch to the very end as I show you everything step by step. All right. So the first thing is professional traders do the homework. They don't just wake up and jump on the market, they prepare. The previous day or before the maybe an hour before before the market opens, they are always preparing. Why? Because it's really really important. So it's all about forecasting. What is to forecast the market? And I've seen most people do. Most people don't actually understand what it is to actually have a forecast. So basically, in simpler terms, a forecast is you having an idea of where the market is going to go. And this is not just done randomly, no. This is done by following your strategy. You go into the market, you screen through the pairs that you trade, and then you find those that actually meet your criteria. And then you focus like, okay, from the way the market looks right now, I think the market is going to come here, right? So, what I want is the market to actually take out this. Then I want it to come here. Why should it come here? Because we have a nice drop based rally with big momentum candles with a lot of imbalance. Therefore, there's a high chance that the market may come to this level right here before we can proceed. That is a forecast. That is not a signal, guys. That's not a trade signal. It's a trade idea, right? So that's the difference. You forecast so that you prepare, you set your alert. So that once the market comes here, now you're able to make an informed decision whether to buy or not. What's going to cause that is depending on the price action of the market at that current time. That's what's going to make a decision whether you are going to buy or not buy. That's how it's supposed to be done. So I've seen this several times when I've posted forecast on our Facebook page and our YouTube. And then, I mean, the trade didn't even give us an entry signal. Then I will see someone commenting stop loss hit. I just laugh. I was like, wow, okay, I think I have to actually talk about this, right? So a forecast is not a signal, guys. It's just a trade idea that is following my strategy. And if it follows my strategy, I like it. I think there's a high probability. Yeah, I'll go ahead and actually post it, right? And then what you have to do on your end is to wait for your control for your confirmation candles. It's for you to wait for your entry signals when the market comes to that particular area. I don't just jump in when the market comes here. No, I don't say just alerts. And I always do, you guys. I don't trade using pending orders, right? Because you're going to take a lot of unnecessary losses. So when I see the market coming here, I'll make a decision. I'll wait for the market, then I'll wait for certain things which I'm going to talk about later, right? So make sure you watch until the very end, right? So that's how it is, guys. A forecast is not a signal. A forecast is basically just you telling yourself, like, okay, this market has given me this, and this sign, and I think if the market comes here, I'm willing to actually buy because this has met my criteria, this, and this, and therefore it qualifies to be an A plus setup. That's how it is. So you have to prepare in advance. Don't just jump into the market. Prepare advance, create a watch list, and all that. Right. So the next thing is the entry. Now the market you forecasted when it was still here, it has come to your zone, right? And you can see that the market was pushing with big momentum candles to the downside. And you can see that the market almost went all the way. And if you had put a pending order here, you'd have been triggered out and you would have taken a loss unnecessarily. But because you're in the market, you are waiting, you are watchful, you are a professional, you wait for the confirmation candle. You can see that the market is in my zone, and you can see that the market is reacting. You can see that the market is reacting right here. The market is showing me signs of pushing to the upside. That's what we call a reversal candle. So there are different types of candles that you're supposed to look for when the market is in your POI, right? So I'm going to share some of the things right here. So these are the types of bullish and bearish reversal patterns. These are the things that you're supposed to be looking for when the market is in this area right here. So go to the 15 minutes time frame, the 5 minutes time frame, and find these candles right there on the lower time frame before you can execute. So this is a bearish engulfing pattern. So this is what you find when the market is on your supply zone. You look for these. You look for bearish tweezers, the evening stars, right? You can see that these are two rejections. These are just telling you that there's a higher chance the market is going down. It's rejecting higher prices. Then we have uh, a bullish engulfing pattern. This is a bullish engulfing pattern, which is showing you that there's a higher chance of you price going to the upside. When you see the bullish engulfing pattern at this area right here, there's a higher chance that the market is going to go to the direction. All you have to do is just wait for the candle open after that. The opposite is this one right here. You can see doji candles right there. Evening star, you can see that we have we've got a hammer right here that you want to see when the market is actually on a demand zone. You have to see this right here. A morning star, you want to see this when the market is in a demand zone. A shooting star when the market is on your supply zone. These are the kind of confirmations you look for when the market is either on your supply zone or your demand zone before you take a trade. Not when the market is just coming down and you've not even gotten any sign of the market reversing, you've already placed a trade. That's not trading, guys. You have to wait for confirmation at this level right here. Go to the lower time frame and see how the market is reacting. Right here on the 5 minutes time frame, you can maybe on the 3 minutes you'll be able to see the market actually closing with a hammer. And that's my confirmation. And you can't appreciate it on the 15 minutes time frame or on the 1 hour time frame. On the 1 hour time frame, it will look like just one big drop with a rejection. But on the lower time frame, there's going to be either an engulfing pattern or a hammer or anything, right? So these are the kind of confirmation candles you're supposed to be looking for. So take a screenshot of this and study them. Don't just take trades from a forecasted area. No, wait for confirmation. It's going to change the way you trade. Very, very, very important. I hope this is clear. Then there comes trade management. So once you've entered the trade, what are you supposed to do? So others go for what they call set and forget, where they just take a trade and then just wait whether the market is going to hit take profit or whether the market is going to hit target. I mean, stop loss, right? And unless if you're trading with a 1 to 1 or 1 to 2, yeah. But when we trade like us, where we aim for 1 to 10, 1 to 15 risk reward ratio, you need to actively manage your trade by either trailing your stop loss or taking partials. I've already talked about this in the past several times. These have both advantages and disadvantages. Of late, for a long time I've been using pending. I've been using trading stop losses. However, I've also encountered issues where the market comes and takes you out, and then the market goes to take profit. The market takes you out, goes to the take profit, or takes you out at 3 hour, goes to take profit. Yeah. So I'm going to be looking into taking partials and see how it works. So, but they both have advantages. One thing I love about trading a stop loss is that you are trading a stop loss behind structure, and you only put a stop loss to a level where you think if the market comes to that level right there, the market becomes invalidated and you have to get out of the market. And that's why I love trading a stop loss. And also, it allows me to use full volume. Unlike taking partials, if I enter a particular trade right here and if it goes 1 to 3, I take like 50% off, then the position is not the same. And if the market goes all the way to take profit, I'd have actually missed out on a lot because I've halved my position. So for me, I prefer trailing over stop loss and everything. Of course, like I said, they both have advantages and disadvantages. It's just a matter of you actually accepting and willing to just go with one. and you have to choose. So you can see the market, once the market goes in the direction and breaks certain levels, I like to move my stop loss to break even so that I don't lose anything if anything happens at that particular time, right? Remember, the market at any particular time, the market can do anything, can choose to do anything at any particular time. So you have to find a way of paying yourself, either by taking partials or by trading of a stop loss. That you have to do. As you can see, as the market continues to move in my direction, we continuously pay yourself. There's a famous quote by Mark Douglas, which goes like, I continuously pay myself as the market makes money available to me. Because at any particular time, anything can happen. So you have to find a way of paying yourself. All right. Eventually, the market comes to your take profit. All right. So don't be greedy. Once the market touches the take profit, don't be greedy. Don't be a greedy pig, because a greedy pig, guess what happens to it? It gets slaughtered, right? So as long as the market comes to your predetermined level, you exit the trade. There's a reason why I had put that level right there. So don't be greedy. Once the market reaches the target, get out. It's okay. You've made money. Go and rest. Go and enjoy your money. There's no need to try and make more, because naturally, us as human beings, we are naturally greedy. When like something like this happens, you want to hold on and then everything, right? So once the market hits you to take your TP, get out. Also, we have this other one. I couldn't find the focus of this particular trade. This is a very, very nice trade. As you can see here, the market came into my zone right here. What happened? Well, we had a nice pin bar right here. It's a shame you can't see it, but there's a nice bullish pin bar right there. And after coming to this level right here beautifully, drop a rally. We have also the Asians that taken out both high and the low. Then the market comes to my level. That's a trade I would take any day. Any day. If the market gives me that confirmation, I'll take that trade any day. Guess what happens? The market goes to your stop loss. Actually goes a bit in profit and then eventually turns and takes you out. That is going to happen. That is guaranteed to happen. You are going to take losses. You have to, because that's normal and you have to get used to it. Losses are part of the game. The moment you accept losing, you are already one step ahead, because most people don't think they can control wins and losses. Both wins and losses are outside the circle of our control. You and I cannot control the market. We have no control over that. So the sooner you understand that, the better. All you have to do is follow your process. Follow the strategy that you've back tested several times. When you do that, guess what? Everything else becomes easy. As long as the market meets your criteria, regardless of what happened on the previous trade, whether you had a 10-hour trade, where I had 3 losses in a row, the moment your setup appears, you are obligated to take the particular trade because it has met your criteria. Simple as that. No buts, nothing. You have to take that particular trade because it has met your criteria. The outcome of every individual trade is random, and there's no way to know in advance which trade is actually going to go in your direction. The sooner you understand that, the sooner you are going to actually start changing up there. So it's really, really important. Take all trades that meet your criteria. So, bonus tips. When you see a setup, ask yourself, is this setup complete and aligns with my strategy? If it does, then you have to take the trade. Entry point is clear, whether you're taking limit or a market execution, make sure that is there. Stop loss and take profit defined. You have to have these things in there. Don't take a trade. Don't be dumb. Don't take a trade without putting a stop loss or having no idea how much you're risking on that particular trade. You just randomly gambling. That won't end very well for you. Risk per trade is calculated, like I've said. Risk per trade is calculated. Not exactly. I mean the dollar amount. How much money are you standing to lose if that trade goes against you? You have to know that in advance. If you don't, then you're going to be checking your phone every 3 seconds, trying to see what happens. And every pip that market moves in your favor, you'll be anxious. Every pip that market moves against you, you'll be sweating. So know exactly how much money you are standing to lose, and you should be okay with that. Also check the fundamentals. Sometimes news events are going to be, and then you know that these things are actually going to affect the market. So when news events are there, make sure you check your calendar and see what is happening on the particular day before you even start trading. Check the calendar, see if with a lot of high impact news there, and then accept the risk or stay away. Accept the risk or stay away. If you can't stand the heat, go home. Go home. Number last is confidence is high and emotions are low. Take a trade that meets your criteria. Make sure you've done everything to actually ascertain that that setup is a high probability setup. And then make sure your emotions are balanced. You've accepted the win and also the loss. You've accepted the outcome of the trade, either a win or a loss, and then just execute. If you can do that, I'm telling you, you're going to separate yourself from the 95% of traders who are consistently losing money in the market. I hope you found value in this video. And if you have, let me know in the comment section. Comment and let me know what you've learned from this video. And also, subscribe, like the video, turn on that bell notification so that you get to be actually be the first one to see when I post such content like this right here. All right, guys. Until next time, goodbye.